Hello and welcome to the Opus Wealth Style Podcast. I'm your host today, Evan Wohl, joined by my trusty partner, George Papanicolaou. George, how you doing today?
Good to see you, man. Happy to be on.
I'm glad we're doing this. Today is an interesting one. A ton of clients love to have conversations with us about investing in real estate, and there's many different ways to do so. Today, we're going to have a conversation that is maybe a little bit more unique, or something that we find most people are not aware of when it comes to how to invest in real estate, or at least one way to do so. We're joined by Brendan Tammany, Senior Vice President, Private Capital with Inland Securities. Brendan, thanks for joining us today. How you doing?
Oh, doing well. Thanks, Evan. Thanks, George. It's a pleasure to be here.
Awesome. Well, let's jump in with just some of the basics. What do our audience need to know just to set the ground rules, and then we'll get into some more of the details on what it is that we're talking about today. George, you want to kick us off?
Yeah. So this all kind of came about because, as Evan said, we have a lot of clients that talk to us about a lot of different alternative investments, diversifying their portfolios, and real estate does come up a lot. And there's times where people sell an existing property, and there's a certain thing that you could do that's called a 1031 exchange. And oftentimes people don't want to purchase another property, or it's very difficult to purchase another property, which we'll get into some of the details. And they do so through something called the Delaware Statutory Trust, a DST. Brendan is an expert in this area. I've personally worked with him a bunch over the last couple of years and helped me tremendously. So I'd like to start really with Brendan. If you could give us like a 10,000 foot definition of what is a Delaware Statutory Trust, or we'll refer to it as a DST. It's a lot easier. And we'll start there.
And actually, sorry, Brendan, sorry to interrupt. Maybe before we do so, again, compliance wants us to say this, so it should go without saying, but I'm going to say it anyway. All of this, you should be reiterating and speaking with your tax advisor. This specific strategy is for accredited investors. So for an individual, that would be earning over $200,000, for a joint household earning over $300,000, or a combined household net worth of over $1 million, excluding primary residence. There's some other factors that could get you in there as well. But those are the kind of the main things. So with that, Brendan, take it away.
Yeah, thanks. Okay, so the DST, or Delaware Statutory Trust, is really a portfolio of commercial real estate that it offers fractional ownership to investors. So you could think, if you're going into a portfolio that has one property in it, you'd be maybe one of 100 or 200 potential investors in that fund. But what you're doing here is you're buying fractional ownerships. You're getting an ownership percentage of the property or properties that are comprised in that portfolio.
I personally own real estate, residential and commercial, and how we always talked about it was the terrible T's, right? So dealing with tenants, dealing with like clogged toilets, dealing with the trash and the maintenance of a property. How does using a DST allow for an institute go from that to an institutional passive owner?
Sure. So within the DST, this is a purely passive investment strategy for the end investor. There's no management responsibilities at all. That's all handled at the trust level. So it would be exactly that. It's purely passive. The investors would be going into these DSTs traditionally through a 1031 exchange, where they're selling a physical property that they've been managing on their own, and they take their proceeds and invest them into one or more, or several Delaware statutory trusts. By doing so, they will be relinquishing their control of the property that they're now a partial owner of. But to your point, yes, you won't be having to deal with the terrible T's, the taxes, the termites, the trash, tenants, everything else that may cause a headache to you. Typically, we're seeing folks come in and you continuously roll over their proceeds, so they'll be invested with us or any other sponsor that's out there that's offering these types of investment strategies throughout the holding period, maybe 5 to 10 years. And at that point, they can take their proceeds and do a subsequent 1031 exchange and roll it back into more Delaware Statutory Trusts.
I've had conversations with clients over the years where they'll say, I own some real estate and pay a management service, 10% or whatever it may be, in order to get what it sounds like, the DST is offering in terms of real estate exposure, but without having to deal with being a landlord. Is there a primary difference between the two?
Between having a management company or going in here, primarily the difference between what our portfolios are offering are going to be institutional quality properties. For our firm, our typical acquisition price is around 100 million, give or take, depending on the property that we're buying. But typically, it's going to be out of reach for your everyday investor to go out and buy on their own. So the way our firm Inland structures our portfolios is they're always going to be asset class focused. So we may have several portfolios that are out there in the market at any given time, but they'll be built within one asset class. So we'll have maybe a self-storage portfolio available in addition to a senior living portfolio or a student housing portfolio or an industrial portfolio, what have you. Within each portfolio, you're going to have properties in that asset class. You may have just one property, you may have several. But what you can do within the DST is diversify your proceeds into several. And now you're going to get asset class diversification and geographic diversification as well. Versus your everyday investor who may have one property, or maybe they have a couple and they have a management company handling it. They're still involved, right? Where here it's going to be purely passive, where Inland or whoever is managing these portfolios is making all of the decisions at the property level.
So they're not picking the individual properties, they're getting a portfolio diversified across geographies and different asset classes within real estate. Is that right?
Correct. That's correct. I get that question all the time. And no, you can't pick the specific properties within a portfolio. You're buying an ownership percentage of each property that is in the portfolio at that time.
Got it.
It's also important to note, so whoever has gone through a 1031 exchange, it's a serious undertaking. First off, it's like a race against the clock. I believe it's 45 days, right, Brendan?
Correct. 45 days from the date of your relinquished property. So whenever that title changes hands, that's going to start your clock.
To reinvest, and what they're doing is trying to bypass capital gains or defer capital gains for a period of time, and utilizing a DST is literally hitting the easy button on a lot of that stuff because it's structured in a way where you're able to do all the important things like identify the property. You work with a qualified intermediary, which you have to find, and very specific. It can't be just any attorney. But all of that is done so seamlessly that, personally, when I've done a 1031 exchange using a DST, the client multiple times said, it can't be this easy. It can't be this easy, because he had done it in the past. And, it was great. It makes me look great. They're also very happy with how it is very hands off, where, you don't have the same liquidity like we were talking about. So you can't leverage the property, but you don't have any of the daily, terrible T's that you have to deal with. So there is income that comes off of it. Some properties have debt, some do not. And I mean, Brendan, do you want to kind of talk a little bit about that part?
Sure. The leverage piece on how that would all play into effect. Absolutely. So when you're going through it or doing a 1031 exchange, in order to have a full tax deferred exchange, which is what I assume everybody wants, and that's not always the case, but for this conversation, assuming you want a full tax deferred exchange, I think the easiest way to understand it is you need to replace the full amount of real estate that you sold using your net proceeds. Now, there's going to be some allowable expenses and things that we can get into, but typically, if you have a property that you're selling for, let's say, $1 million, and you have a $200,000 mortgage on the property, net proceeds that you're going to have after you pay off your debt is going to be about $800,000, and you'll need to replace that $1 million worth of property with using your $800,000 that you have available at the qualified intermediary. In order to achieve this, you can invest into, if we're talking Delaware Statutory Trusts, there's trusts out there or portfolios that are constructed with financing attached to those properties, like a mortgage. And typically they're structured as maybe a 10-year interest only note, or maybe it's 5 years and 5 years of amortization. It may vary. But the point would be there's financing on these properties. So as an investor going into this DST, as an owner of this property that you're investing in, you'd be taking on what's called an assumed debt, meaning you're getting a piece, your ownership percentage is now also buying a piece of that debt that's attached to that property. And that debt is going to buy you additional real estate that you would need in order to achieve that $1 million, real estate or fair market value real estate that you're acquiring. Typically, when you're looking at DSTs, you'll see we talk loan to value. So that's going to be a common term or LTV. The loan to values that you normally see for a traditional DST that's cash flowing would be between around 40 to 50%. And sometimes there's a little variance on either side there. But you can diversify into multiple DSTs, some that have higher leveraged amounts and some that have lower, in order to achieve your end result being a full tax deferred exchange, to make sure you're replacing the full amount of real estate that you sold.
Now, if it's fractional ownership, who's making the decisions around liquidity events, when to sell properties or to refinance debt?
It would be the sponsor. So in my case, Inland would be making that decision on when that we would be selling that specific property or properties. I think when talking DSTs with multiple properties, sometimes the sum of the parts is worth more than the whole. So you might find a DST that has 3 properties. Ideally, we could sell all 3 at the same point, maybe 6 or 7 years into the holding period. Now, if we find that if we sell these 3 properties separately, they're worth more, then we'll go ahead and do that as well, which can lead to multiple 1031 exchanges for the clients coming out of that sale, because each individual sale of the property would be treated as its own 1031 exchange.
And how does it work for distributions if the client, I don't know, they had their life changed and they said, I want to liquidate this, I want to turn it into cash, even if it's realizing the taxable gains? How does that work?
It's really difficult. I would view these as illiquid strategies. I think anyone listening to this should go into a DST investment with that mindset, that you typically have a 7 to 10 year, 5 to 10 year holding period somewhere in there. It does vary on asset classes, etc. There is a secondaries market out there. Inland's uninvolved with that, so I can't really talk too much about that. I'm just not educated in that space, but my understanding would be it would be at a pretty big discount to what your principal allocation would be.
So clients going into it need to know that this is an illiquid investment. They're doing it to get real estate exposure, likely to defer the tax on a previous sale, and maintain passive income, or start earning passive income without having the active management. Does that sound about right?
Yeah, absolutely. And I think that's something to think about when doing a 1031 exchange. If you're going to utilize DSTs, is think about, do I need cash within this this certain time horizon? And if so, you're able to pull cash out of the exchange. So with my hypothetical earlier, you have $800,000 at the qualified intermediary. You can pull some cash aside. Now you'll pay tax on whatever you take home. This is called a partial exchange, but maybe you pull some cash out for a rainy day fund and the rest goes into the DSTs. So that's something that we often talk to advisors about, to educate their clients on that, just so they don't have an issue down the line where they need to exit and there's no liquidity for them at that time.
Really cool thing also with the DST is if God forbid something happens to the person, during the time where it's still in the holding period, their estate gets that step up in basis. Now they can't exit the property until the property itself is sold, until there's that liquidation event. But as far as legacy goes, it does fall in line with that, where they're still getting the step up in basis, which is also something very beneficial to the client who's making that decision to take that route instead of buying another physical property. And it's kind of a great lead into my next part. So a lot of high net worth clients are seeing a big influx of alternative investment options right now, right? So things like private credit, public and private REITs. Brendan, can you break down mechanically like how a DST differs from a standard REIT and private credit fund?
Sure. So the way I explain it would be the main difference between a REIT, which is a real estate investment trust, the acronym would be REIT, and a Delaware Statutory Trust or a DST is really where your equity lies. So in a REIT, you're buying shares of a holding company that owns real estate properties. In a DST, you're buying the properties themselves. Your equity is actually going into the property, and it's that distinction that allows a DST to be a like-kind exchange vehicle for the purposes of a 1031 exchange. It has to be a like-to-like exchange or a like-kind exchange, which just means it has to be a property that's held for investment purposes, and you're exchanging that for one or multiple properties that will be held for investment purposes. If you're exchanging say, a warehouse that you own and you're selling that, going into a REIT wouldn't be a like-kind exchange because now you're selling that for shares of a holding company that owns real estate. You don't actually own the property itself. Private credit funds, sure, they may be involved in real estate as well, but really they're on the opposite side. They're acting as the lenders to these companies or real estate companies,
Mm-hmm.
and then they're going to be earning an income off of the interest of the loans, but you're not actually owning the properties themselves. So again, it would be you be ineligible to exchange into something like that. So I think the big benefit of the DST is actually having ownership percentage of the properties in the portfolio themselves.
Direct ownership that's what
Exactly.
allows for the 1031,
Exactly.
where you can't get that with REITs or obviously with private credit you're investing in the debt side where creating passive income, but you're not necessarily investing in real estate. You're investing in their ability to lend and create yield.
Exactly. Yeah. All great strategies in their own right, but for the purposes
Sure.
of deferring your taxes, then the DST would be the solution there.
Yeah, you own your portion of that offering, right? That property. I think it's a very cool thing to be able to do because we're talking about 1031s, but there's also for accredited investors, as we were talking about before, that I've personally used who buy into it using cash. So, Brendan, kind of let you start this off. Why would someone who's an accredited investor want to use non-exchange money, liquid cash, to buy into a DST?
Sure. I think that would come into some of the benefits of the DST is going to be access to institutional quality property. You're going to have limited personal liability on there. The investment minimums, I mean, for cash investors, maybe that's around 25,000. I think, George, the type of property that you'd be able to invest in our portfolios is going to be out of reach for if you're trying to buy a physical property on your own to manage for 25 grand. And you won't have any of the headaches of actually managing the properties themselves. So I think it's a great approach to now. Maybe you're doing a ladder approach and you're investing every year into different asset classes. So now you're going to have exposure into self-storage or industrial, student housing, senior living facilities, whatever your interest is at that time and whatever you're excited about. You'll be able to do that versus with your own cash buying a physical property on your own. I think the limited personal liability, if there is debt on it, on the property, that's going to be held at the trust level. So it's not, in an absolute worst case scenario, say the property goes into foreclosure, the bank won't be coming out to these individual investors. You're going to be protected in that regard. Your major risks here are obviously like that with any other investment strategy, which would be complete loss of principal.
Brendan, I've found that DSTs are not really well known. It's just my personal experience working with a lot of clients over the years. Any idea why you think that is, or what are the major downsides to something like that?
Yeah, it's funny. Before even getting into the space, I had never heard of Delaware
Yeah,
Statutory
yeah.
Trusts. I think they're relatively new. I think it was in 2004 that
Hmm.
the Delaware Statutory Trust was deemed to be a like kind of investment vehicle. So we're really only 22 years into this. I think before it was TICS, was what everyone was using, tenants in common, which had uh, which were great at the time. But I think the DST offers a lot more flexibility, and we can have more investors in the funds, and you don't have to have everybody vote the same way to make a decision. The highest risks, I think the biggest struggle, I think, for a lot of the folks that end up investing in DSTs are most of our investors are real estate professionals that own maybe one property. Maybe they have a pretty significant portfolio in their own right, and relinquishing control is pretty difficult for them.
Mm-hmm.
They're attached to these properties. Once, the way I like to view it is there's always that one property that's going to be a thorn in your side, no matter what kind of portfolio you've constructed for yourself. And maybe you're holding on to it strictly because you don't want to pay tax, and you don't know that this type of strategy is out there. And if anyone listening maybe can relate to that, maybe you start there, and you finally have an outlet for that one property that is just causing you too much time and effort. So you sell that property, you do a 1031 exchange into one or more DSTs, and see how that works out for you.
And for accredited investors that want to add real estate or potentially add real estate into their portfolio to diversify, and that's where the cash piece came in when I originally did it. They don't have the time or capacity to go ahead, and they may have the funds and the ability to purchase, but it's a lot of it is time. It's one of the things that we can't make more of. So it's a way for them to include real ownership of property, hands off. Again, you're lacking in some of the utility of owning a physical property, right? Like we said, like the direct leverage and stuff like that. However, you do own it. And, Brendan actually just mentioned it before, like the laddered approach. That's a unique thing you can do where you can, every single year, you can earmark a certain amount of money and you're buying a new property every single year, which is paying you income. You don't have to worry about the terrible T's. And then you'll have a series of, liquidation events later on where you either choose to take the funds, invest into something else, or you're already in the 1031 platform, so you can just 1031 into another property. It's a unique. It is interesting that a lot of people have heard about it, myself included. The first time I heard about it was through a 1031 exchange, and then when I saw the little cash piece on the bottom, I said, "Oh, you can buy into cash." And Brendan was extremely helpful in explaining it. And then I had a bunch of clients who absolutely loved it because they had always asked me about purchasing real estate, but they don't know about it. And if they've dipped their toe into that pool, a lot of them don't like it because it is very difficult. It is very time consuming. It is dealing, whether it's a commercial property, residential property, and it leaves a bad taste in their mouth. This similar, not the same, but it super interesting and a unique offering, to say the least, and definitely a good alternative. And just to kind of just interject again, for everyone, tax features like depreciation are a massive part of real estate tax laws. They're incredibly nuanced and always subject to change. Everyone should definitely consult their own independent tax and legal advisors regarding their specific situation. So it's important. We're talking about something that has a lot of different moving parts. So we're trying to make it easy to follow, but there's a lot of different pieces involved. So as they are, sophisticated, DSTs are on the more sophisticated side, powerful tool for the right investors. What other types of things do you think we should know about this, Brendan, before kind of wrapping up?
Sure. I think some of the benefits here that maybe I haven't covered already would be, I think we did touch on the estate planning aspect, which is a huge tool for those that do have real estate portfolios and they want to be able to pass these down to their beneficiaries. You still have that ability with the Delaware Statutory Trust.
Meaning the step up in basis?
Meaning the step up in basis, exactly. Mm-hmm. Now, with the illiquidity of a DST, the timing might not be as favorable to you, but at the end of the day, if that original investor does pass away, their beneficiaries will receive the step up in basis there. They'll receive income if the DST is paying an income, and then at exit, they'll typically, that's when we see them go their merry way. There's no real tax incentive to continue doing a DST. The elimination of boot, what would we advise is even if folks are doing a 1031 exchange and they want to buy a physical asset to buy on their own, the boot, that remaining, maybe they're, in my example before, you need to replace $800,000. You need to replace $1 million real estate property with $800,000 of net proceeds. Maybe you find something for $500,000 that you want to buy and manage on your own, but you don't have a place for that remaining proceeds. A DST can absorb that, and now you've replaced your $1 million of real estate. You have your proceeds are split between a physical asset you bought and now a DST as well. That way you don't have any boot that's going to be taxable. And then the swap till you drop feature does sound a little morbid, but there's no rules on how many times you can do a 1031 exchange. So oftentimes you'll do an exchange and that investment will run its course. When it's sold, you can just do a subsequent 1031 exchange with your proceeds from that sale, and you just roll it into one or more funds or investment properties to manage on your own, or a whole blend of them, whatever your strategy is. But you can just keep rolling that over until you want to utilize that estate planning piece, until that investor passes away and their beneficiaries receive the step up in basis. So it's a very powerful tool to utilize.
That's awesome. Brendan, we really appreciate you coming on. This is super interesting. So for, I think, a lot of people who are dealing with real estate, especially maybe a liquidation event, and they feel either stuck, they don't want to, either keep being a landlord or just pay the taxes. This seems like definitely a good opportunity or a good allocation to look at for either a portion or all of your real estate exposure. And because it is illiquid, it's important that you have other stuff going on, right? So it's part of a bigger picture of an overall plan. You've got liquidity, exposure to the markets, and real estate paying passive income. So this has been super interesting for the listening audience. If you have more questions or you want to speak a little bit more detail about if this strategy makes sense for you, obviously reach out, and George and I would be happy to have a conversation and introduce you to Brendan when it makes sense. Brendan, any following or final thoughts, or where the listening audience could reach you if they want to get in touch directly?
Sure. I really appreciate the time and the opportunities to be on here with you both. If you have listeners that are interested, I'm happy to get on a call with you, George and Evan, just to educate them on Inland and our current products. My direct line is 630-990-8405. They can email me at btammany@inland-securities.com. We'd be more than happy to assist or just answer any questions and help guide you through this process.
Awesome. Well, we appreciate it. Glad we had this conversation. To the listening audience, hope you enjoyed it. Please do like and subscribe if you want to be acknowledged for when we have the next podcast coming out. And we've got a lot coming up, so stay tuned. But till the next time, thanks for joining us, and we'll talk to you soon. Thanks, Brendan.
Thank you both. I appreciate it.